For the next 15 minutes, I'm going to talk about hiring and firing managers and best practices for navigating the active management landscape. No doubt, asset allocation is going to be your roadmap. But we spend an awful lot of time discussing managers, performance, comings and goings, and so forth. Brian mentioned earlier, I've spent my entire career, really scary, meeting with investment managers. I've probably heard every strategy under the sun. So I'm the only thing between you and lunch, so let's dive right in. Once we've established our asset allocation framework, we want this. Our Monopoly man here embodies our ultimate goal, managers that outperform their index and peer group. But what we often get, the cyclical nature of the stock market and human nature, often means that we follow this pattern. A solid track record attracts attention. Everything looks fine and dandy. The portfolio manager's experienced. We're excited. We decide to hire them. The first periods start off great. Everybody's happy. What could go wrong? We're brilliant. They're brilliant. Uh-oh. Things start to go south. Things continue to go south. Several quarters in a row of underperformance. Maybe some board members are really unhappy. How could we be so wrong? Maybe the manager is then terminated and the cycle starts all over again. So how does this happen? What goes wrong? First off, let's discuss timing, or more aptly, bad timing. The blue bars here represent the mutual fund flows in 2012 in each of these broad asset classes. You can see that investors bought heavily into fixed income and sold out of US equities that year. The red line is the subsequent return in 2013. So you can see that investors who sold out of US equities missed out on some of those big returns the following year, and investors who piled into fixed income were barely able to break even. So, best practice, stick to your asset allocation, your strategic asset allocation. The data shows we are better served by sticking to that plan and filtering out short-term noise or whatever else is happening in the market. So, chasing returns has a big impact on ultimate performance. And this chart shows the 10-year annualized total return of broad asset classes versus investor return. So what is investor return? Investor return incorporates cash flows. So because it incorporates cash flows, it measures how the average investor performed over time. So what are we seeing in this chart? We're seeing a large gap between the fund's listed total return and what the average investor actually experienced. And the gap is particularly large in international equities, more than 300 basis points over a 10-year period. This is investors swapping in and out of products. So swapping in out of a product that maybe is underperforming to a product that they think is going to do better. But remember, you cannot buy yesterday's outperformance, only tomorrow's returns. The thrill of the chase, thinking that past performance can indicate future returns, that's a formula for continually underperforming. And this data doesn't even incorporate transaction costs, days out of the market. If that were the case, you can imagine, you'd be even further behind. And there's a real impact to chasing returns, and that's the real cost of lower performance. Now, as an aside, here you can impress all your friends at your cocktail parties. Who knows the original name of Mr. Monopoly here? Does anyone know it? I hear some grumblings. It's not an answer. Okay, ready? Rich Uncle Pennybags. He first appeared in 1936. Now, no one carries pennies anymore, so maybe he'd have to be Rich Uncle $20 bills now, but alas. I've shown you a lot of Morningstar data, my former employer, who, by the way, we do not get a discount on. So Morningstar has lots of useful data on mutual funds. And you may be sitting there thinking, well, that's retail investors. Institutions, we're a lot smarter. Well, not quite. We get it wrong too. This is a study by AQR, and they looked at hundreds of institutional plans out there and summarized the results. So here's the scenario. We've heard this before today. Your current manager underperforms. The blue bar is the 2-year return. Potential manager you're looking at is in red. They look great. Let's hire them. Then what happens? The new manager underperforms the next 2 years. Given transaction costs, time out of the market, and not to forget the intangible time of the board in selecting that manager, probably better off sticking with the manager in the blue bar. All right, so now let's have a little fun. We're going to have a case study. I'm going to describe the scenario, and then by a show of hands, you guys can vote. Manager underperformed for 3 consecutive quarters due to an outsized energy bet. Assets have declined 10%. There's been no personnel turnover. Who would keep this manager? Wow, almost everyone. Who would fire this manager? I would suggest to you that you keep this manager. Here's why. Keep in mind, the manager has underperformed for 3 consecutive quarters. If you hire an active manager, underperformance will happen. Expect some, but not sustained underperformance. Now, to put some numbers behind that, on this slide, we looked at eVestment Alliance data, this is institutional products, and examined the number of consecutive quarters active managers underperformed in various asset classes. Let's take large value. The median manager underperformed 5 quarters in a row over a 10-year period. Institutional small cap, 4 quarters of underperformance is the median. And even the very best manager underperformed for 2 consecutive quarters in international small cap. So when we see underperformance, our thought may be to put that manager on alert or even terminate. The refrain of, don't just sit there, do something, might run through your mind. But a best practice is to fight that instinct to overreact to underperformance, especially if it's short term, because outperformance will happen too. It's not all doom and gloom if you hire an active manager. The median active large value manager, again, the second set of bars, outperformed 6 quarters in a row over that same time period, while the median international small cap manager outperformed 7 quarters in a row. So, best practices. Know why you're hiring a manager and what place they serve. Set parameters for alert and termination. Every board is different. It has different priorities and risk tolerance. But guidelines can help in times of stress. If a manager underperformed for 3 quarters in a row, like our example, do you want to take up 20 minutes of board time discussing that? Probably not. Set some rules up front as the decision to hire active management is made. Now, there are reasons beyond performance to put a manager on alert or even terminate. So here's some best practices here, some things to keep an eye on. The first is style drift. You hire a manager for a reason, to execute the asset allocation. If your US small value manager, for example, is drifting into mid-cap or growth, it's time to take some action. The next is asset bloat. This is more important in some of the less liquid asset classes, and we certainly want managers to close products in a timely manner. Still, that sometimes doesn't happen, and the manager cannot effectively manage $10 million as well as they did with $500 million. So moving on, you hire active managers to be just that, active. If the product is skewing so closely to the index that you can't barely tell the difference between its return and its respective index, it's likely time to move on. Certainly, you hire an active manager for the talent of the portfolio manager. So what happens when the portfolio manager leaves? Need to be prepared for change. Now let's talk about that on the next slide. All right, we're going to look at 2 scenarios about portfolio manager changes. Firms change, people come and go. Manager tenure can be short, and this statistic nearly had me falling off my chair. Nearly a third of investment firms in our industry have average manager tenures 0 to 3 years. 0 to 3 years. So one of the #1 issues you may face as a board member is what to do when my portfolio manager leaves. Okay, so which of these scenarios is more palatable? Scenario 1, portfolio manager abruptly leaves. One senior analyst and junior analyst remain. The firm replaces the departed portfolio manager with someone from outside the firm. Performance has been good, and this is a fundamental strategy. Scenario 2, the longtime portfolio manager plans retirement for 2 years. The senior analyst is molded for succession. There's 5 other analysts on the team, and this is also a fundamental strategy. Okay, so by your little fingers, which scenario do you guys think is better? I love it when everyone flashes the peace sign at me. Okay, clearly scenario 2. People matter. Succession plans matter. They can show the strength of the firm and how much thought they've put in sustainability of their investment products. Best practice. Be wary when you see an abrupt departure, especially at the senior analyst or portfolio manager level. It tends to spell something more fundamentally wrong at the investment firm. Now we're going to do a should you hire. Let's look at another case study. This product is presented to you. Top quintile 1 and 3-year annualized returns. Above average fees. The portfolio manager has been on the product for 4 years, and there are 3 analysts. All right, another raise of hands. Who would hire this manager? Doesn't matter the asset class, just pick your favorite. Whoa, no hands? Wow. Ding, 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 you're all correct. Either that or you're not listening, one or the other. No, I'm just kidding. I know you're listening because you're laughing at my bad jokes. Okay. Hiring a manager simply based on 1 and 3-year performance is the worst measure of future success. Let's take this example. Back in early 2008, you were looking for a new active US large value manager. This bar shows what you would have been looking at. The triangle represents the top quintile managers as of December 31st, 2007. Great. Let's hire one of those managers. What happened to those managers? In 2008, on average, they were in the 43rd percentile. The next year, in 2009, they were in the 48th. Now, if you guys remember, 2008 and 2009 were dramatically different market conditions. But those managers that had been on the top performed very similarly the next 2 years. And then on the last bars here, the next 5 years, those managers on average ended in the 59th percentile. A disappointing record that likely would have led to termination on many plans. Focusing simply on recent performance, especially one point in time, is not a successful formula. If you were to focus on one data point, I would offer to you it should be fees. Overwhelmingly, across all asset classes, the lower the fee, the stronger the likelihood of outperformance. This example looks at US equity mutual funds and the predictive power of fees. We divided up the universe in quintiles and then looked at the subsequent 5-year performance. Clearly, look at the far left bar. The lowest fee had dramatically better performance, while the highest fee, far right bars, had the worst. And the difference is not small, nearly 200 basis points over a 5-year period. Best practice, vigorously negotiate low fees. That leads into our other conclusions. These are the don'ts. Don't chase returns. Watch out for under-diversifying. Avoid following emotions. That's probably the hardest one. Don't just focus on the past and avoid overemphasizing short-term returns. And on the other side, more importantly, as we discussed today, set expectations up front, invest strategically, diversify risks, accept discomfort. There is going to be some. Even the best active managers underperform. And of course, my favorite, negotiate low fees. So what does that add up to for when to fire and when to hire? Each active manager should be examined on their own merits, but some good rules of thumb. When to fire, when to get out, style drift, assets under management are too large, closet indexer, poor succession planning, and sustained underperformance. When to hire, The process fits a need. The portfolio has a need. The strategy offers a competitive advantage and low fees.